Now, I'm making this video in my hotel room on my makeshift setup because we finally had a large financial YouTuber speak out about the downfall of fintechs, whether it be Yotta, Synapse, and the overall issues that they're causing. And I have the video linked down in the description. Patrick Boyle finally broke down the issue, and hopefully this, brings more eyes and eyeballs and ears to the situation.
It's Thanksgiving weekend in the United States, which kicks off a holiday season in which Americans eat turkey and watch films about bank runs. These are American traditions. In keeping with this tradition, CNBC reported last week that thousands of Americans have seen their savings vanish with the collapse of a financial tech company.
Yeah, finally CNBC released an article, which, I think that happened like 2 weeks ago. If you're on the Yotta subreddit, I'm sure you've paid attention to this, but a lot of people are finally disclosing that they're only getting pennies on the dollar. And when you think about it, it's almost been or has been a year for many people.
Called Synapse. The article gives the example of a school teacher who deposited the proceeds of her home sale, so basically her life savings, into an influencer promoted bank called Yotta. She first found herself locked out of that account. This went on for over 6 months.
Now, a lot of people think that this is like a one-off case, having, someone put in $30, $40, $50,000. But if you look on my comments alone, and I'm a small content creator, a lot of people are talking about how they lost this much money. I didn't know a lot of people were investing in Yotta, but remember my last video, Yotta was portraying FDIC savings account, right? It didn't have the entire website scraped or scrapped at this point because they got rid of all of it. They got rid of saying that they're a savings account or a savings bank. They got rid of the FDIC logo. They got rid of all of that. And if you think about it, that's sketchy on their part.
And last week she learned that she would only be getting $500 of her $280,000 back from
$500 out of $280,000. I just want y'all to think about that when, man, I'm not in that position, so I'll, act my wage, but having $280,000 in a single bank when the FDIC, amount is, $250, that's already, but you can't blame the victim in this case when they were already believing that they're trusting this bank, right? And at the end of the day, we saw that this overall issue is affecting thousands.
From Yotta. That is 0.18% of her savings that they're returning to her. She is, of course, not the only victim. According to a court-appointed trustee, up to $96 million of customer funds have vanished entirely. At Yotta, which was a fintech, not a bank, despite being promoted as a bank by a number of big YouTubers, almost 14,000 customers report that they're being offered a combined 11.
Not just any YouTubers, right? Like Graham Stephan, who's still silent in the situation. I made a video. Make sure you check that out.
$8 million, despite having deposited almost $65 million. It's not clear how this money is being divided up, as some customers, like the school teacher I mentioned earlier, are doing a lot worse than others. Yotta is a particularly strange example of a fintech, where it was originally launched as offering prize-linked savings accounts, which are savings accounts in which the depositor receives a low interest rate, but then has the chance of winning a large amount of money in it.
Yeah, a lot of the times when people look back on what Yotta was, it literally was only portrayed as that lottery-style savings account. Now, I'm someone where I want my money guaranteed, but I understand how they could do that because they could still profit on the end, right? They could offer some users like a guaranteed 0.1% while giving those people, that winning group, like that 7% offsetting essentially what they're doing. So Yotta, on the face of it, like it financially made sense. They were trying to gamify savings accounts, which is really hard to do. So they, turned it into some gambling system or some gambling service. But when you think about what broke down here, a larger play of the whole FDIC middleman between these, front-facing and back-facing, issues, it can't keep happening. And like, there's a point where I think that FDIC, they said that, this isn't their, involvement. When you think about it, like, how is this not?
Sweepstakes. The New York Times described Yotta a year ago as a smart way to turn gambling into a virtue. Andreessen Horowitz, a large Silicon Valley VC firm, explained in their blog that fintechs like Yotta differentiate themselves by appealing to the aspirations and product demands of Gen Z, which I guess is gambling and saving in a non-FDIC insured bank account. And this is why Gen Z are so...
But see, here's the thing. Yotta was advertising that it was an FDIC bank account. And when you look on the face of it, can Yotta even advertise? Like, when Yotta established, they were saying that they were working with Evolve, who's an FDIC bank. Right, like at that point, is it not like front-facing FDIC when all we do is put your money in this FDIC bank? And I guess now, who's at fault there? Because that's what Yotta was portraying.
So hard to understand. Yotta originally offered depositors an interest rate of 0.2%, with the chance of winning up to $10 million, a price they later revised down to $1 million. It doesn't appear that the top prize was ever won, and CoffeeZilla reported on his YouTube channel a few months ago that Yotta pivoted from this sort of gamified savings model into what was basically an online.
That's one thing that I don't think that I need to go back on the Wayback Machine and see what they did, because I think they got rid of that whole like 1 out of a million people can win $100,000 or something like that. But if you know that no one's winning this game, I mean, that should already be a red flag for so many people.
Casino, which they describe for legal reasons as an online sweepstakes model. Yotta itself has not declared bankruptcy, but due to the bankruptcy of Synapse, a fintech company it relied on, its customers lost access to their funds. According to CNBC, Yotta and other fintechs in this online savings space advertised that their deposits were FDIC insured. CNBC say that a contract that customers received from Synapse after signing up for checking accounts stated that user money was insured by the FDIC for up to $250,000.
Now, there was a point, like someone on the Yotta subreddit was asking if Yotta was a good bank because they saw it being advertised, which blows my mind that, you know, Yotta still is trying to market itself. I don't know how a lot of people haven't gone to Yotta themselves about getting their money back versus Evolve, even though we understand how the breakdown was. Right now, Yotta should be going to bat for the users instead of the users talking to Evolve. When you think about it, Yotta is the one that put the users, the fintech is the one who put the users in that position to even fail in the beginning.
The FDIC, in contrast, has been very clear that its insurance fund does not cover the failure of fintechs or other non-banks, and they've said that should such a firm fail, there's nothing they can do. The Treasury Department actually saw this problem coming and issued a report 2 years ago to the White House Competition Council about the entry of non-banks into the consumer banking space.
So, we're already hearing that the federal, market was already tracking this, large end, treasuries and the government was tracking this. So how are fintechs even legally allowed, right? Like, aren't there the Consumer Federal Bureaus of Protection, right? The CFBP or something like that. Like, how is a fintech even allowed to operate if this case breaks down? Like, how, do you understand what I'm talking about? Like, that's not, that shouldn't be legal.
The report argued that while neobanks succeeded in increasing competition for deposits with potential consumer benefits, there was one problem. These firms are generally not subject to the same oversight for safety and soundness or for consumer protection. The report said that the fintechs avoided becoming banks, which is expensive and brings on regulatory burdens, instead choosing to partner with banks so that they both compete with and work with banks, creating regulatory gaps. Those very regulatory gaps are the reason that all of this money can't seem to be traced, and one of the VCs who funded Synapse, the fintech that collapsed, has been in the press this week saying that certain financial regulators need to be shut down as they are slowing down his innovative business practices. Before we go any further, let me tell you about this week's video sponsor.
Now, just leading up into this, his ad read, I don't understand how consumer bureaus are even allowed to let a regulatory gap go by like that. When you think about that, right? The government is understanding that there's a regulatory gap, and for most consumer business practices, they insure or disincentivize companies from even touching funds, right? Like if this were, let's just move this into something else, crypto, right? They don't allow crypto exchanges, an American crypto exchange, to even operate, but that's a regulatory lapse or gap, but they allow it. Right? Like they understand that there's a practice or a procedure in place. Coinbase has to follow these rules or else they have to be shut down. There's not an American fintech that should be allowed to skirt these gaps. It makes no sense, right? Let's just zoom forward.
I'll let the always well-spoken Mark Andreessen explain the issue himself.
So, for example, we have this thing called the Consumer Finance Protection Bureau, CFPB, which was it's sort of Elizabeth Warren's personal agency that she gets to control. And it's an independent agency that just gets to run and do whatever it wants.
What does her agency do?
Whatever she wants.
What does it do, though?
Basically, terrorize financial institutions, prevent new competition, new startups that want to compete with the big banks.
Really?
Oh, yeah, 100%.
How so?
Just by terrorize.
He said the Consumer Federal Bureau of Protection that protects users against, like... All right, here's the thing. If you're making over like $100 million, I already have like a red asterisk towards you, because I understand that you play a game, you play a political game, and that's all he's doing is probably playing a political game to skirt around regulatory regulations.
Harassing anybody who tries to do anything new in financial services.
Can you give me an example?
Well, like I said, debanking. This is where a lot of the debanking comes from, is these agencies. So debanking is when you as either a person or your company are literally kicked out of the banking system.
Like they did to Kanye?
Exactly, like they did to Kanye. My partner Ben's father has been debanked.
Really?
We had an employee
For what?
For having the wrong politics, for saying unacceptable things. Under current banking regulations, here's a great thing. Under current banking regulations, after all the reforms of the last 20 years, there's now a category called a politically exposed person, PEP. And if you were a PEP, you were...
All right, now this is where things probably get political. You know, we don't really cover politics on this channel, but I don't know the actual insight to this. I'm sure Patrick is breaking it down. That's why he's talking about it.
required by financial regulators to kick them off of your, to kick them out of your bank.
What?
You're not allowed to
What
have
if you're
them.
politically on the left?
Well, that's fine.
No.
because they're not politically exposed.
So no one on the left gets debanked?
I have not heard of a single instance of anyone on the left getting debanked.
Could you tell me?
Now, we might need to fact check some of what Mark just said. While the CFPB was originally proposed by Elizabeth Warren in 2007, she was removed from consideration as its director by the Obama administration and has never headed it up. Its current director is Rohit Chopra, and I don't know if Mark struggles with face blindness or something like that, but it's not easy to mix the two of them up.
See, and that's like one of those things, like, I understand when you try to play politics, because, right, the clickbait, it sounds good, right? It sounds good, but, you know, what's actual happening in practice? And I think there was a quote recently when it comes to following clickbait titles, which is follow the source, right? Like, take me to the source. And, you know, I guess that that clip right there, if you go to the source, it's not who he's saying it is. So, like, at that point, I can't trust you, right? So, you know, what game are you playing?
Rohit is a 42-year-old man of Indian descent, and Elizabeth is a 75-year-old woman of... Well, it doesn't matter. It's hard to mix them up, is what I'm really trying to say. Now, the audio seems to be a bit off in this section.
What does it do, though?
Basically, it terrorize financial institutions, prevent new competition, new startups that want to compete with big banks.
Make
I
fun
think
of
what Mark
stuttering.
is saying, and I may be wrong, is that the CFPB supervises banks, thrifts, and credit unions with assets of over $10 billion, also supervising non-depository...
Now, like I talked about earlier, like, when you think about regulatory bodies in the government, I mean, they play a role, right? Like, there should be like an FDIC compliance where the government ensures that the people have a safe place to bank, right? Like, let's just understand that. And like, with assets over $10 billion, I'm guessing that that other guy is a billionaire, and that's above my pay grade. So I'm pretty sure that I would talk crap about it too, right? Like, if you had the possibility of just talking crap about a government and shutting it down, I mean, and that's why you have that red asterisk next to your name, that red flag. Everyone should understand, like, just because someone has money, you have to understand they you know, they played the game, right? And that's what we try to do in this channel. We try to, you know, let's talk money.
mortgage originators and servicers, payday lenders, consumer debt collectors, international money transfer.
Dude, if you're telling me a government body oversees payday lenders and you're trying to get rid of them, we understand that they scam the lower third of the population just because it benefits the payday lender with like a 300% APR, right? Like, you're trying to, if you were to tell me like the CFBP gets shut down, man.
And private student lenders. It's in place to protect consumers from being ripped off by financial services providers, but it doesn't yet cover fintechs like Yotta and Synapse. Mark accuses the CFPB of being involved in debanking, and in particular, debanking conservatives. This is entirely untrue. In fact, they do the opposite. They investigate banks for discriminatory treatment of customers. He goes on to effectively change the subject entirely to discuss
Man, Patrick Boyle's bringing the facts.
politically exposed persons. And while that's outside the scope of this
crazy.
video, I do happen to know a bit about that as I ran a fund for many years. I'm amazed that Mark runs a multi-billion-dollar fund and doesn't understand these rules. Politically exposed
shots.
persons are people like politicians, their families, and their close business associates. If a politically exposed person, let's say someone like Hunter Biden, wants to move a large sum of money into a bank or an investment fund, the financial institution accepting those funds is required to investigate the source of those funds, which usually involves asking the customer where the money came from. If they say it came from selling their house or liquidating...
I mean, that makes sense on all fronts. I mean, if you've ever tried to get a mortgage, right, the lender... They ask where you got this money from. If you just immediately had like a deposit of $100,000, even though you transferred your own $100,000, they're gonna you're like, hey, the funds don't track. Like, where'd this money come from? So like, what is it? The underwriter. That process is strenuous. They make sure that people have the money and like it didn't come from anything sketchy. Like, you can't just pay. Like, so on the face of it, that makes sense. Like, these agencies need to have oversight on stuff like this.
another investment, you then have to ask them for documents proving this. This can be
makes
a
complete
bit
sense.
awkward and embarrassing, as your customer often feels accused of wrongdoing, but most people in this position are used to these procedures, which are in place to prevent politicians from taking bribes or having bribes passed to their family members or business associates on their behalf. If Elizabeth Warren wanted to invest $1 million in an index fund, she would likely receive this sort of scrutiny. She would have to explain the source of the funds. Now, in today's day and age, if a politically exposed person wanted to put money in your fund and said that the money came from crypto gains, there's a good chance that you'd be unable to take that money.
Yeah, and that's sort of why I think a lot of the banks, what they do is they operate on like an automatic decline or automatic suggestion of no. I know a lot of people, whenever they try to link their bank with, name a crypto exchange, Coinbase, Coinbase, Kraken, Gemini, any of those, they'll often have purchases or transactions declined or held, especially if it's a large amount. I mean, that makes sense, right? Because they need to verify that the funds are legal, because if the money, comes from someone else or a source that it shouldn't have, I guess the bank, in that case would be the ones responsible in the eyes of the government. So, I mean, if you were a bank, you'd probably do the same thing.
As crypto is widely used in money laundering. A lot of crypto people get upset when you say this, but financial institutions can get in a lot of trouble if they touch dirty money. So crypto gains or gambling wins will lead to even more scrutiny until a financial institution can be sure that the money was earned honestly. When Chase closed Kanye West's bank account a few years ago, who I believe prefers to be called Ye, this was no different to a restaurant or any other private business refusing to serve a customer. It's constitutionally protected. Now, I'm going to take Mark at his word that he wants to have the CFPB shut down because of this debanking issue that he possibly misunderstands. But Mark unfortunately missed this press release on the CFPB website that came out about a week before his Joe Rogan interview about how they're going to crack down on illegal debanking, which I'm sure he would have been delighted about. Oh, and there's another bit in there about how they plan to supervise the largest fintech companies. Now, maybe Mark's firm doesn't invest in fintech firms and he didn't hear about this new development a week before he was on Joe Rogan's podcast. Let's take a look at his website. Oh, look at that. Synapse, that's a fintech, isn't it? And there's loads of fintechs and crypto stuff on the list.
Oh, man. See, and that's why you have to have your red flags on all 100 millionaires and billionaires. That's like one of those things. Like, he's playing the game, right? Like, okay, look, there's another one, V-Friends, right? Like, he oversees, invests in, and has ownership of these assets in which are risky. And we know that Synapse is literally the one that went bankrupt and is essentially at fault for the... Okay, so if the CFBP has oversight of exactly the fintech middleman that collapsed, that's why he's going after them. That's crazy. And like, this is happening in broad day.
The list. You know, the kind of stuff that American consumers might need to be protected from. They should probably remove Synapse from their list of investments, though, because it did go bankrupt. How would Mark not know about these investments? It's frankly, it's all over his website. Does he not listen when he's sitting in the meetings? Here's a blog post on his company website from 2021 about fintech cozying up to the creator economy. Oh, look, a video link. Oh, come on, Mark. The YouTubers know how to cover their tracks, and you're leaving everything up on your website. Come on. Okay, so let's back up a bit. What exactly is a fintech anyhow?
Okay, so I mean, and that's like when you can't trust these people, right? Like, I mean, at the end of the day, they don't have your interests, right? That's like, I know that they don't have my interest when I see stuff like this.
Well, the word is just a combination of the words financial and technology, and it's used to describe the use of technology to deliver financial services and products to customers, and it can apply to areas of banking, insurance, investing, or anything that relates to finance. Examples range from peer-to-peer payment services like Venmo and Zelle, to robo-advisors, to stock or crypto trading apps like Robinhood, to app-based insurance companies like Lemonade. Most of them advertise online, pick a narrow area of finance like taking deposits or making short-term loans, and try to do it cheaper than a bank would, often by automating customer service and by not needing any physical...
Yeah, that's the thing where I see fintechs come into play, right? Like, and that's why they partner with banks. Whenever I think of a bank or I think of a large institution, I think of like a Vanguard. Now, if you've never used Vanguard's investing website, it's old and doesn't have that right feel. And that's where someone like a Robinhood was able to come into play and, take that entire marketplace, because it's revolutionized, it's modernized, it's where, to meet the customers. And a fintech's role should be to meet the customers where they're at in a streamlined process. It's okay if they want to profit off of it, as long as the consumer at the end of the day gets their value, right? Like, because that's, what we're talking about is a value exchange. As long as you're not essentially stealing or siphoning money from me, or in this case, shutting down and there's no regulatory oversight, the role of a fintech is just to modernize current solutions that we actually need in 2024.
Branch locations. Synapse was a fintech company that connected other fintech companies like Yotta to banks. When you deposited money at Yotta, it was passed to Synapse, who deposited it in a bank which held the money and was FDIC insured. What Synapse did was keep track of whose money was where. Yotta just needed to design a gamified front end that people liked using and organize the sweepstake. Synapse kept the records and a bank held the money. Some of the fintechs like Yotta promised enhanced FDIC insurance of up to $500,000.
Okay, so that's why in the beginning that lady had more than $250,000, because that makes more sense, right? Like, because you know, as like a consumer, that FDIC is literally up to $250,000. So anything above that is sort of your risk in the event something shuts down. But when you're thinking about like the whole front end, back end, you're not really thinking of a middle end, right? Like when you're talking about Yotta, you know the front. When you're talking about Evolve, who is the actual bank behind it, right? The Evolve's website's not pretty, so that's the back end. But you didn't think about an extra fintech on top of the, like in the middle of both of them. That makes no sense, right? Because at that point, who's to say that there's not a middle for the front end who's like, what if there was a Synapse A and a Synapse B, right? Like Synapse 1 and a Synapse 2, right? Like how many different layers does it have to get messy? And if we're talking about years ago and when the Federal Reserve talked about, say, how this is oversight, like how many years does it take for regulatory oversight to actually stop that, right?
On their websites, explaining that the funds would be deposited across a network of FDIC-insured banks. Synapse.
So that's how they're able to get the FDIC. Instead of having 250 in one bank, Yotta partners with multiple banks to have that in, stretched across it. And so they're able to offer, say your money's in, Evolve 1 and Evolve 2 kind of thing. Okay.
Describe themselves as a banking-as-a-service provider, where they provided the back-end software for around 100 different fintech companies who had millions of customers, and they deposited the money at 4 different partner banks. The fintechs and the banks all relied on Synapse to track transactions and account balances and determine how much money was in each customer account at all times. Rather than licensing their software, Synapse struck deals with both the banks and the fintech apps. They handled customer onboarding, KYC, and anti-money laundering checks, record-keeping, risk management, and all other compliance functions. Synapse created for benefit of accounts at the 4 partner banks they dealt with, where the fintech customers' money was deposited into interest-bearing pooled accounts.
And I think this is where the role of, like a regulation or a regulatory body is insight. Now, I don't want to cover this entire video. Obviously, you've probably seen the video or it's linked down in the description and you can go check it out there. If you like this kind of content, or you like these kind of conversations, subscribe to the channel. I have other live streams that I've been trying to cover this case. I'm trying to move away from the whole Yotta situation. It's a bad case overall, but I understand that other larger content creators need to talk about it. Ideally, Graham Stephan, because he was the one who was a private investor in it. But at the end of the day, that's all I have to say in this. Hopefully other larger content creators, because small guys like me can't be the only voices because we'll never be heard. And if you have nowhere to go and you are a Yotta, if you were affected by Yotta, go and make sure you check out that Yotta subreddit, because that's essentially where everyone else in the community is bonding together. Peace.